Morning, good afternoon, and good evening to all. Myself, Vaibhav. In today's session of automated trading, we are working with the EMA envelope, and in today's session, we are adding Williams percentage R, and this we are doing to kind of increase our probability of getting bigger trades, and we are working with 4 hourly time frame, and we just want to make sure that after a long rally or fall, when it will enter into a consolidation phase and when the new trend will begin, when the direction will reverse, only at such times we want the trading to happen. And for that purpose, we are bringing in the oversold, overbought conditions with the help of Williams percentage R. We have done earlier sessions, I think almost 4 or 5 sessions with EMA envelope. So I hope you are well familiar with that if you have attended the earlier sessions. And if not, it's pretty simple. The moving average envelope uses a percentage of the simple moving average and the standard deviation of desired value, and we basically try to see in which direction the EMA envelope is moving. If it is rising, we look for buy trade. If it is falling, we look for the sell trade, and within the price band which we are using, which we are defining using the standard deviation of 0.1. The Williams R indicator is just like the stochastic, but here we have a simple difference, and here the difference is that Williams percentage R has an upside down scale, and all the values are in negative terminology, so that is the difference. And of course, the absence of internal smoothing is also, but apart from that, it's pretty handy, and if we work with it, you will see the min max and the average true range, the volatility gauge. Before we get started, here is the standard disclaimer. I would like to remind you that this is simply a tutorial session to help you learn how to build efficient algorithms, and of course no claim is being made regarding the profitability or otherwise of the algorithms which we will be developing during the session. And suppose if you want to use any of these, I would suggest that you do extensive trial runs and then allow it to run for the sufficient enough time on demo accounts to get a clear cut idea of how things are shaping up. And of course, nothing in the webinar is to be constructed as an advice to trade or for any particular setup. With that note, we start new day. This is the first day of our session, so first of all, let me try to explain you the whole idea. So here, our earlier algorithm was trading as long as the EMA envelope was rising, it was looking for a buy trade, and as long as the EMA envelope is falling, it was looking for a sell trade, provided the candle close is also in that direction. So we were selling if the candle close was below the high band of the EMA envelope, and we were buying if the candle close was above the lower band of the EMA envelope, provided other conditions were also fulfilled, and there was no restriction per se for how long the momentum has been on that side. But now what we are doing is that we are bringing in the Williams percentage R indicator, and as you can see here, once this change happens somewhere here and then here, you can see that most of the time the Williams percentage R remains with a value which is above -70, and then finally after this change here and steep fall, we get a reversal, and then the value falls and it remains considerable for considerable amount of time. It remains below -30, and why I'm saying -70 and -30 is that After going through these historical charts, on many occasions I have found that these two values are fairly indicative of the oversold and overbought conditions. So you can, even if you want, you can utilize the values of minus 80 and minus 20, which are traditionally used while working with the Williams percentage R indicator. But I think even if we go for the combination of minus 30 and minus 70, it's fairly good. And given the fact that we are not going to go for trade straight away, one more restriction which we will be putting in. So here you can see that once the overbought or oversold condition is reached, the trend reversal doesn't happen immediately. So here, after this correction, the overbought territory is reached on 18th of March around 5 GMT, and as you can see, it remains in overbought territory for quite a considerable amount of time, and till the change of trend is there, we see that value keeps hovering just little above and below this minus 20 range. And to make sure that we are not trading against the trend, we are using this EMA envelope. As you can see that EMA envelope's values consecutively stay in a positive direction. We were using the combination of current EMA envelope price band values, and we were comparing those values to the values a day back using shift 6 on 4 hourly time frame, and that setup we are going to use in our today's algorithm as well. And similarly for Williams percentage or also, we are going to work with the current Williams percentage R value and the value a day back. So we are bringing in the shift 6. So what happens, suppose after reaching this oversold value, and here the trajectory is bearish, so it won't be looking for a buy trade. But let us assume that suppose if this value is not falling and we have rest of the conditions which are fulfilling the buy trade. So let us assume for a moment that apart from the Williams percentage R, rest of the conditions are conducive for a buy trade. But since we are going to compare the current value to the value 6 candles back, we won't be looking for any buy trade even if the oversold territory is reached. We will wait for a day, and that will mean if for the first time if the value has fallen below minus 70 on 5 GMT of the 26th March, then the trading will happen only after 5 GMT of the 27th March. So by that time, again, selling pressure might have subsided or it might not. But that's not the point. But the thing is, we are not going to go against the trend when the when the momentum is pretty strong, and we are going to wait it out. And one more benefit of comparing the current value to the value shift 6 periods back is that our trading will be open. So here, if suppose we are going to, as you can see here, I think let us compare the values if the buy conditions will be fulfilled as per the EMA envelope. And here the value of high band is 107.71, and we go back 13 GMT of 1 April. No, it won't be fulfilled. Let us again check for 17 GMT. Here we have 74.5, and no. So we go for 21 GMT. Here we have 107.80, and okay, now as you can see, EMA envelope buy conditions are being fulfilled at 21 GMT of 2nd April, and let us go back on the Williams R. So suppose if you want to look for a buy trade, here the Williams R has already reached a overbought territory. But since we are comparing the current value and the values using shift 6, that is the values a day back, so we get to go back almost a full day and we can see the value at 21 GMT of 1st April, and then the value was minus 72.63, so it was still below the requirement of minus 70, and that will help us trade, and we can go for fresh trade here also. So even after the significant up move has happened because of the strong momentum after being in the oversold territory, we can still go for a buy trade, and that is precisely because we are comparing the values with a lag of 1 day. Suppose if we simply use the last 4 hours values, then I think this won't be possible. So that's why we are sticking with this format. And one more thing will be, now that EMA envelope and Williams R conditions have been discussed, the next question arises: when we are going to go for a fresh trade, and what should be the immediate condition? And in today's algorithms, which we will be developing for next couple of sessions, I am not hopeful that we will be able to complete it today itself. So for next couple of sessions, we might do continue working on it. And for these algorithms which we are developing using these indicators, we will be not using the pending open, we will be using market open, but we are going to define a price band. So suppose if we look for last 10 hours or 12 hours minimum value, which will be of course dynamic, and then using the ATR price band. Suppose if we want the trade to happen whenever the after rising substantially, whenever the price will come closer to the lowest value of last say 12 hours, and when it starts to rise from those levels, we will look for a fresh trade. So maybe 10% or 20% of the ATR from last 12 hours minimum value should be a good enough combination, and of course rest of the conditions which we have already defined will also help us determine that setup. So now, and we can also do this with one more condition. I think we will need to put in the requirement of some min-max conditions to just make sure that the trading happens only during upside momentum, and to make sure that is the case, we will need to bring in some min-max conditions, and on the lower time frame that should be helpful. So we will see when we reach that stage how to optimize our setup. Now we start to make the bare bone structure, and then we will add the conditions as we deem fit. Today we are working with on tick, and last time we were working with on candle. Now since we are going to use the open at market and the 10 seconds candle to get the entry point, so we want to make sure that we don't miss out on trades, and for that every tick will matter. First, we bring in the if candle for doing the instrument subscription and the position amount. Today is also the Friday, so I will not try to go into much depth. We will add just the required indicators, and then we will build on it in next week. Default variable, default instrument, and default instrument we are continuing to work with the euro usd. Suppose if you want to change it to usd jpy, so now if you are feeling bored working with the euro usd every time we have used euro usd, let us try with the usd jpy this time, no issue. So we have to first search where is the usd jpy, it is here, we got it, save. Now, since we are doing the instrument subscription on the take, we have to take this last take instrument, and last take instrument again should be equals to USD JPY. We got it. It should be equals to, and it should be again equals to. Now let us bring in the position amount on position amount. Suppose if any other algorithm is working on your account, and if it is working with the pending open condition as well, even in that scenario, if there is any pending order on account, then also no trade will happen. Now we will need to bring in the Williams R conditions and EMA envelope blocks, and of course the min-max blocks as well. First we bring in the EMA envelope. Here we will need two EMA envelope blocks of the 4-hourly time frame, just like we had done till yesterday's session. We change this to 4 hours. And shift 0 and shift 6. Time period remains 14. The deviation remains 0.1. So we let it remain on the bid side. Upper side is bid. Closing price, it's okay, no issues. Now we bring in the Williams R, and for us Williams R can be found here in Bill Williams indicator. Again same thing, 4-hourly time frame, one with the shift 0, another with the shift 6 setup. Percentage time period is 4 hours. Shift 0 and shift 6. Okay, it looks good. Now we need to bring in the min-max blocks. We will be comparing the min max values of last 12 hours. Basically, we are going to define the entry and the exit points using the mathematical, and here is the min max condition. We will need two blocks, one bid side and another ask with the high price, bid with the low price, and we want the data for last 12 hours. So I think we can do one change here, and if we use the time period of half an hour, we will need 24 candles, or if we use 1 hour, then we will need 12. So let us go for half an hour, 24 combination. It should be good enough. Here also half an hour. Shift will remain at 0. We are going to utilize the current values. Let us also color this flow so that we get to immediately know if there is any problem. Now we need to change this to 24 candles of half an hour will be equals to 12 hours. Minimum and the maximum. One will be bid price and the low price. Another will be the ask price and the high price. So this is the case so far. Now we will need for the min-max blocks as we had done in yesterday's session, and that will be to make sure that when I will need to show you on the chart with lower time frame, say pardon me. So here, when the price is falling, as you can see, the min-max conditions, the minimum value will be continuously getting lower and lower, and only after say 10-15 minutes of consolidation, when no new low is being made, we will see that the current minimum value would be equal to the minimum value of say 10-15 minutes back. So we are simply using this condition to make sure that if there is for any reason, if there is a sudden fall, no new trade should be made, and only after stabilization of the price mechanism, our algorithm should look for the trade. So we are bringing in this 15 minutes condition. We will be comparing the 1 hour's minimum value of current candle with the 1 hour's minima 15 minutes back. That is just to make sure there are no trades when for any unforeseen circumstances, if there is a sudden sharp move, and in such times, suppose if the liquidity dries up, we shouldn't be caught on the wrong foot. So just to make sure that is for the safety purpose. So we bring in one hour's data using min-max combination. We will need 4 min-max blocks, one on the minima side, one for the maxima side. We add these blocks here. We will make it 5 minutes and here also 5 minutes. Shift will remain 0 and one will be bid low price and another will be ask high price. Okay, and 5 minutes into 12 candles will be equals to 60 minutes data. We do that. Now we need to bring in 2 more min-max conditions. So here we have ask side and so here we will again change 10 minutes to 5 minutes. Oh. Shift will be 3. Time period will be 12. And here bid and the low price. And in another candle we will go for a ask and the high price to find the maximum. On the bid side we will take the minimum value. Here we change it to 5 minutes. Shift 3. Time period is 12. And here we change the bid to ask and the closing price to the high price. And then we will compare the current minima and the maxima to the minimum maximum values 15 minutes back respectively. So I think today, as now we are slowly running out of time, we will need to continue to develop our algorithm on Monday. So far, I hope you have got a fairly good idea of how and how we are trying to implement our requirements for the trade execution, and for that we will need to do a lot of optimization in coming sessions. So I would like to thank you all for joining in for today's trading session. Have an excellent weekend ahead. See you on Monday. Goodbye.